So Anthony, you have an interesting strategy in terms of M&A and renewable energy finance in the US. Often a company comes in to buy post-operations, they come in to build the project and deal with financing. You find a middle ground between developer and long-term buyer.
That's correct, Brian. Thank you so much for the question. So we're sort of that middle road, we're that middle child, as I would say, between projects that are being developed and projects that need to be owned. And what happens is a lot of developers and also long-term owners don't want to take on a lot of the construction risk and a lot of the brain damage or gymnastics that's required to get these assets built. So as a company that has a very large balance sheet, we need to deploy our capital, exercise the assets that we have in our EPC business to turn the capital over to really be that lubricant to get the deal executed.
So you basically do one thing. You buy it to build it, and then you sell it when it's operational.
That's correct. So we buy a notice to proceed, we build it on our balance sheet, and then we'll exit at mechanical completion or when the asset is actually ready to be operational. One thing that we also do in conjunction is provide construction finance. Now, there are a lot of companies out there that provide construction finance very, very well, but it's more of in the form of a debt. And we provide pure equity. So we would build that asset on our balance sheet. It's a non-recourse structure. No equity required by the developer, no equity required by the long-term owner. And then we would wait to get paid at COD. So we're actually extending a trade credit to the developer and the long-term owner. Again, exercising our ability to turn capital over, and then we would get taken out with a takeout investor.
So are you the owner of the asset during the point of construction? Are you more a debt provider or all the above?
Actually, in a construction finance role, so let me work backwards.
Please.
In a construction finance role, we never own the asset. We'll take the asset as collateral.
Okay.
And then when we get taken out, when we acquire an asset, we will acquire the SPE, so we will own the asset through the due diligence process, through the financing process, and through construction right on to selling it at COD.
Do you get outside debt to help you out or no?
No, we typically haven't had that opportunity to be presented to us. As we grow as an organization, we did about 350 megawatts last year. As we grow as an organization and look into different markets, that might be something we would look at. But our trajectory is to grow geometrically right throughout 2017.
So last year you did 350. You're going to do how much this year?
We did 350 megawatts last year. We're probably going to be on target to do north of 700 megawatts, probably close to 800 megawatts. We just took down a 350 megawatt portfolio at the beginning of the year. I have assets in the southeast as well as the northwest, so our trajectory looks pretty good to hit that 700 or 800 megawatt number.
Is this solar? Is this wind?
Since we're hedge fund based, we think in terms of how do we deploy capital in inefficient markets.
Okay.
Once markets become more efficient, our ability to make our returns are going to be much, much smaller. So we don't mind solar being inefficient, so solar is the way to go. And as you know, with
rooftop, utility scale?
Scale right now for us is all ground mount, ground mount and solar farms.
Utility scale?
Totally a scale.
So, and they have PPAs with utilities, or who's buying the power from these assets?
So ideally, all of our assets are what we called QF, qualified facilities, so the offtake is going to be the utility.
Okay.
So the power is purchased by the utility.
These are per contracts?
It's a per contract, exactly. We are looking at some community solar opportunities as we branch into some upstream greenfield development work. It's still in the early stages, but right now it's how do we de-risk the project? And de-risking the projects are per projects.
So for a hedge fund, we often see that kind of player take part in mezzanine debt. So it's sort of corporate, quasi-project, somewhere in the middle. There's a certain kind of risk profile that we see them attracted to. You're getting involved in the ownership of the assets. It seems like an obvious play for any investor who has capital that sees like there's like this middle ground where the money is needed, but we don't see hedge funds do it very often. What do you guys see that others don't?
I think for us, and I'll let the hedge fund attorney speak to that particular question, but what I can tell you from an investment acquisition perspective is that we've created something in the market that is so unique, but yet so obvious.
Okay.
And I think a lot of long-term owners are so focused on waiting for the asset to be built, and developers are so focused on how do I get my capital, reinvest it, and build more and develop more assets. That logical middle piece was just never created. I call it serendipity, call it a moment of an aha moment. We were able to step into the right position at the right time, and with the backing of York and the great team that we have, our team in Charlotte and myself in New York and some of our team out in Colorado and California, we've been able to make it work and keep the process very, very smooth and, again, grow geometrically. That's our goal.
Serendipity.
Serendipity.
Thank you very much.
Thank you, Brian. Thank you.